Looking to buy your first home? Union Savings Bank and Domicile Realtors are here to help. Over the next 30 minutes, get educated on how you can qualify and learn more about the home buying process. It's time for you to get on the path to home ownership.
Hello, and welcome to Get on the Path to Home Ownership. My name is Keith Borders, Vice President, Community Development at Union Savings Bank. A key component of economic empowerment and building wealth is owning your own home. Over the next half hour, Brent Taylor, broker, Domicile Realtors, and John Smith, Senior Vice President, Union Savings Bank, will help you get on the path to home ownership. Our journey begins with Brent and identifying the right home for you.
Thank you, Keith. Today I'm going to be talking to you about the benefits of owning versus renting. I'm also going to be speaking to you about some of the myths that people have about home ownership. And lastly, I'm going to break down the home buying process for you today from start to finish. First, let's talk about the benefits of owning your home versus renting. When owning a home, the first thing people think about is, man, I want a nice house, which is great. We all want a nice place to live. But there is also another factor that comes along with home ownership. And that factor is not only are you purchasing a home, but you're also making an investment for you and your family. Purchasing a home is one of the greatest ways to establish economic empowerment. Statistics show that homeowners' net median wealth is 80% larger than the median wealth of a renter. So when you purchase a home, not only are you purchasing a nice house, but you're making a great investment for you and your family. How does that work, you ask? How is it an investment, you ask? I'll tell you. When you purchase a home, there is a thing that is associated with owning a home called appreciation. When you purchase a car, you'll drive off the lot and the car will lose value immediately. When purchasing a home, on average, your home will possibly appreciate 3 to 5% on a yearly basis, depending on the market and the economy. So for what you pay for a home today, it'll be worth more tomorrow. Not only that, but every month when you make your mortgage payment, you're not just paying the bank, but you're paying yourself. You're paying down your loan. Eventually, you will have paid down your loan, but then what you purchased the home for the value will have increased. And that creates what we call equity. So when you own a home, you have equity. Equity is the difference between what your home is worth and what you owe on your home. Another benefit of home ownership is you're able to, at the end of the year, write off the interest on your taxes of what you paid. This is a great benefit for homeowners. Establishing equity, building equity, your home is appreciating, and most of all, knowing that with you paying down your mortgage, you're in a sense paying yourself, your home is appreciating, and at the end of the day, you will have the peace and the confidence to know that you're no longer paying for someone else's dream, but now you're paying for your own. Now, I want to talk to you about some of the myths of home ownership. I've been doing this a long time, and over the years, I've noticed that when I talk to people, a lot of them are not currently homeowners, not because they don't qualify or because they can't, it's because they just don't know they can. And they probably had some misconceptions along the way about home ownership. what I found is that what stops people most of the time is a combination of a lack of knowledge and fear. One of the greatest myths that people have about home ownership, which stops them before they ever even try to open the door, is they believe they have to put down a large sum of money, 20%. They believe they have to put down 20% on a $100,000 home. That would be $20,000, and they're thinking there's no way I don't have that kind of money. This assumption is false. There are loans available where you can put down as little as 3%, 3.5%, 5%, and in some cases, depending on your income, you may qualify for a grant where you don't have to put down any money at all. Another myth that people have about home ownership is that mortgage payments are so much higher than rent, and there's no way that I can afford it. This again is false. On average, the national median rent, I believe, is about $1,300 per month. $1,300 is about equal to purchasing a home for $200,000. So again, owning your home is affordable. Just because it's a mortgage does not mean the payment is going to be more expensive than rent. Lastly, and this is, I believe, the biggest myth that people have about home ownership, is that you have to have perfect credit. I have spoken to people throughout the years that believe they have to have 700, 800 credit scores to purchase a home. This again is false. I can tell you that there are loans where your credit score could be as low as 600 and you could still qualify to purchase a home. Now, I'm going to break down the home buying process for you from start to finish so you know what it will take for you to become a homeowner. The first step is you need to become pre-approved for a loan to purchase your home. This is important because you need to know that your credit will qualify you to purchase a home. You also need to know how much home you can actually afford to purchase. The next step is you will need to find an agent to represent your interests as a buyer. Domicile Realtors has several agents that are ready and available and eager to work with you and for you. Now the fun part, we search for your home. Once you have found a home to your liking, we will together with you write an offer for the home and negotiate price and terms with the seller. Once all parties have come to an agreement, congratulations, you now have an accepted contract on your home to purchase. Now that you have an accepted contract on the home to purchase, you will now hire a professional inspector to inspect the home from top to bottom to address any issues found with the home prior to closing. Once the lender is notified that the repairs are being addressed from the inspection, they will then order an appraisal on the home. The lender wants to make sure that not only is this a great investment for you, but for them as well. They want to make sure that you're not overpaying for your home. Once the appraisal has been received by your lender and the value is equal to your purchase amount, the file will be submitted for final loan approval. This is where your approval status moves from pre-approved to final approval. Once final approval is granted, you are now ready to close on your new home.
Now that you've found your perfect home, how are you going to pay for it? John Smith with Union Savings Bank joins us to help you with your home buying journey.
When asked how they qualify for a mortgage, most people, even those that have bought several homes, don't have a clue as to how they qualify. Actually, mortgage lending is nothing more than a mathematical calculation, and most of the guidelines are even available available online to those of the general public. So we're here to pull that curtain away from mortgage lending today and show you, give you the knowledge of what's important for you to qualify for a loan. Knowledge is power. We're here to give you that power. The first thing we want to talk about is the generalities of mortgage lending. There are 4 different mortgage loans available for home buyers today. They are conventional, FHA, VA, and USDA. We're not going to talk much about USDA and VA loans today because they're specialized programs available only to veterans or those borrowing in rural areas. We're going to talk more about conventional loans and FHA loans because they're available to the general public anywhere in the country. So let's dive in. There are 4 basic rules for qualifying. We call these the 4 C's of mortgage lending. They are collateral, credit, capacity, and cash. We need to look at all 4 of these legs independently, but then we need to look at the whole picture as well. 1 or 2 legs being weak can be supported by a couple of other strong legs and still support approval. But if you have too many weak legs, that means you have what's called layered risk, and therefore that does not support approval. So let's dig into what these are. The first we have is collateral. Collateral, when you're talking about mortgages, is the house. You've already talked about the house, but you need to know that the lender is going to do an appraisal on your property. That appraiser is going to give the lender an independent evaluation of both the value and the condition of that property. The lender is going to use that information to judge whether that house is good collateral for the mortgage loan you're asking for. It's important to know right here that general guidelines talk about single-family homes being the collateral for the loan. If you're looking at another type of property like a condo or a 2-family house, I suggest you tell your lender right up front because there's some additional requirements and overlays for purchasing that type of property. Once we have the house sorted out, we're going to look at you as the borrower. With credit and income aspects, understand that we're going to try to actually predict the future in qualifying you. We're going to try to guess whether or not you're going to make your payment on time. Since we don't have a crystal ball, we're actually going to take your past and establish a trend line. And with that, we're going to try to predict your future abilities. So when we look at you as a borrower, we're going to look at your past history as well as where you are currently. Now, how do we get your credit report? We actually get it from a credit bureau. There are 3 main credit bureaus in the country today: TransUnion, Equifax, and Experian. What they do is they collect data from lenders and then they report it out. Once something is reported, it stays on your report for as long as 7 years. So if something derogatory shows up, it's there for a long time. Now, you have by law the right to receive a free credit report annually. You can either write to the 3 credit bureaus and ask that they mail you a copy, or you can go online to www.annualcreditreport.com and get an electronic copy immediately. You can look at what's being reported on your report, and if there's any inconsistencies or something that's incorrect, you have the ability to challenge it and actually have it removed. So each of the 3 credit bureaus take the information that's reported to them, and they're going to calculate a credit score. A credit score for you is nothing more than a grade on how you are responsible with your credit. Most people think that the credit score is simply payment history, but it's actually a lot more complicated than that. In reality, your pay history only comprises 35% of your score. And the lenders only report on 30-day increments. So if you happen to not be able to make a payment on the date due, make every effort to try to make that payment along with the late fee as soon as possible, because if you make it before the 30-day period, that lender is going to report that credit as paid as agreed. So it's a big benefit for you. Now, if you happen to have 30-day lates or 60-day or 90-day lates being reported or collections, that's going to hurt your score. And the more recent those items are on the report, the worse it's going to be. On the good side, the longer those things age out, your score will raise back up again. The amount you owe is actually 30% of your score and is just about as important as your pay history. This is broken down into two different categories. First, you have the total amount you owe to everyone collectively, and then you have the amount you owe to your current creditors as compared to the outstanding available balance to you. So if you have a lot of credit overall total, or if you only have a few credit cards, but your balance is maxed out to the limit, you're going to have a lower score. One way to help your score in this category is to pay down your revolving balances to within 50% of their total available balance. You can do this one of two ways. You can either pay the balance down, or you can ask your creditors to increase your limit. Just remember, if you get the limit increase, don't use it. The third category is credit history. Now, this is also a two-parter. First of all, you have the total history that you've been in the system, and then secondarily, you have your history with your current creditors. So a longer history is going to mean you have a more predictable future, and it's going to raise your score. Less history is going to mean a less predictable future, and it's going to lower your score. In this category, many people make a mistake thinking that they're going to pay off a current trade line and close it, and that will raise their score. And in actuality, because you're changing your history, it may actually lower your score. Now, separate from history is new credit. This is separate because it notes a change in your behavior. So a new credit means that your future is now unpredictable, no matter how long your history is. And in this category, you can actually hurt your score by even just making inquiries into your credit, because applying for new credit indicates to the credit bureaus that you're going to change your habits. The last category is 10% of your score, and that's other factors. This gets a little bit harder to grasp, but basically the credit bureau says that some debt is better than other debt. So if you have a loan that has collateral with it, like a house or a car, that's considered better debt than a revolving credit account. It gets a little complicated here because you can have a more risky type of credit that hurts your score in this area, but if you make payments as agreed on it, it helps your score in other areas. So understand that the credit score overall is trying to judge your attitude and responsibility towards credit as a whole, not just whether you can make your payments. All the willingness in the world to make your payments is not going to help you if you don't have the ability to make your payments. So the third leg of the stool is capacity, and that is the amount of income that you have available in order to make that payment. We're going to do the same thing as we do with credit, and then we're going to look at your past in order to judge where your future is going when it comes to your income. The more you're able to demonstrate that your income is reliable and will continue to be available, the more likely your lender is going to be able to use it for qualifying. You have two different types of income. You have stable income and you have unstable income. With stable income, you're looking at your regular wage pay, base wages, your Social Security, maybe income from another person such as child support. With unstable income, you're looking at things like overtime, maybe a part-time job, self-employment. So with stable income, you only need about 30 to 90 days of history in order to judge that that income is stable enough to use for qualifying. With unstable income, you need at least a year and more likely 2 years of income in order to judge that it's stable. And even at that, we're going to average that income over that time frame and only use the average for qualifying. Once we've established that the income is stable, now we're going to concentrate on how much you have, the amount. There are two qualifying ratios that are important to us. They are going to tell us whether you have enough income to support the monthly payment along with your other debts, and then have enough left for incidental living expenses. The first payment is the house payment itself, and that is also referred to as the PITI. PITI stands for principal and interest, which is the payment on the loan, the taxes, which are paid to the county on the house, and your insurance. The insurance is mortgage insurance that might be on the loan, as well as your homeowner's insurance, which is due to the company that you choose. The PITI has to be less than or equal to 31% of your gross monthly income. So for instance, a person making $5,000 a month will qualify for a $1,550 a month PITI payment. Now with today's interest rates, that actually calculates to a home over $200,000. The second ratio is your total debt ratio. With this, we take the PITI payment and add your other monthly debts onto it. The ratio is a little higher because you're allowed to have some other debts. So with a conventional loan, that ratio is 40%, and with FHA, it's 43% of your gross monthly income. So this same person that we talked about will be allowed to have between $450 to $600 a month in debt and still qualify. More debt than that will actually hurt your qualifying ability. So for instance, just another $200 a month in additional debt would lower his ability to purchase a home by over $50,000. That's quite a bit of money. Now, just because a lender says you can make the payment doesn't mean you will be able to make the payment. Everybody has a different lifestyle and budget. So I would advise you to take some time and analyze what might be best for you. And that brings us to the last leg, which is capital or cash involved. And it is the money that's needed at the closing. There's three different parts to this. First is your down payment. The second is your closing costs. And the third is your prepaids. Unlike VA and USDA loans, which are 100% financing, both conventional and FHA require some down payment. With conventional, outside of a couple specialty programs, they require 5% down minimum. FHA requires 3.5% down. This has to be your money from your savings, or it has to come from an approved source. You can't go to another lender and borrow the money. You can't get it from anyone else in the transaction, such as the realtor or the seller. Now, if you don't have the down payment yourself, there are some options for you. First, most mortgage programs allow for a gift from a relative, and that can be used for the down payment as acceptable. Another, FHA has some approved down payment assistance programs. They're usually administered by state or local governments, and they provide you the down payment assistance. However, I do want to point out that they are also connected with a higher interest rate on the mortgage loan, so you really only want to use them as a last resort. There are also some other down payment assistance programs that are here from time to time. You should check with your lender to see if they're available. Closing costs is the next category of money needed at closing. This is things like your appraisal, the title company fees for closing or insuring the title, maybe fees for the loan itself. And these can be paid by anyone. So many contracts are actually written for the seller to pay these for you. If the seller can't pay them, you can talk to your lender, and maybe the lender has a program where by you paying a little higher interest rate, they will be able to pay the closing costs for you. But make no misunderstanding, whether you're paying a higher sales price or paying a higher interest rate, you're paying those closing costs in the long run. Now, the last category is prepaid items. Prepaid items are things that have to be paid down the road. You're going to be paying your taxes and insurance through your monthly payment. The lender is going to collect your payment and set these aside in an escrow account. And then when the bill comes due, make those payments for you. That account needs seed money up front, depending on when the next bill comes due. And so that money is taken up front at closing. It can also be paid by any party in the transaction, so you can negotiate for that in the contract or with your lender as well. So if you can show some responsibility with credit, enough income to qualify for the payment, and enough cash to close on a reasonable house, you can be approved for a mortgage loan. But I want to take this one step farther for just a second, because once you have the loan, what do you do with it? you have to understand your rights and abilities at that point in time. Refinancing a loan is available to anyone at any time. Most mortgage loans today have no prepayment penalty on them, so you can pay them off with a new loan at any time. Loans are written for 30 years, but most of the time, borrowers' needs and wants change well before that. In fact, the average loan that's in the country is only kept for 6.5 years. There's many different reasons you might want to refinance, one of them being interest rates. Interest rates change all the time and they can make a huge difference in savings for you over the long run. For instance, a $100,000 loan at 6% interest will require you to pay over 30 years over $215,000 to pay that loan off. That extra $115,000 is interest that you pay. That same loan at 3% interest is over $63,000 less to pay that loan off over 30 years. That's money in your pocket that you're not taking if you don't refinance that loan. Interest rates happen to be the lowest that they've ever been in history right now. So nearly every home in the country has the opportunity to refinance their mortgage and save money. This is something for you to keep in mind for the future, but also pass along to your friends and loved ones and make sure they know it as well. I have been in this business for over 37 years, and there's one motto that I've formed my career around, and that is everyone can buy a house. Maybe not everyone deserves a house today, but if you find the information out and apply yourself to fit those guidelines, you can be qualified for a house. The important thing for you to do today is to get on the path. Some people's paths are very short. They may be ready right now. Some people's may be a little bit longer. But if you don't get on the path and stay on the path, you won't be able to qualify for a home ever. Get on the path, stay on the path, and you will be a homeowner someday. Not can, but will. At Union Savings Bank, we want everyone to have a home. We want to help everyone qualify and meet the guidelines that are out there. If you have a home that you want to purchase, or if you are in need of a refinance to save money or pull some cash out of the property for other bills, then we're here to help, and we want to help you. Thank you.
Thank you to Brent and John. We really appreciate all the information. Please contact us. At Union Savings Bank, we want to be your partner and help you make your home ownership dreams come true.
Thank you for watching Union Savings Banks and Domicile Realtors Get on the Path to Home Ownership. For more information on buying your first home, contact Union Savings Bank at 513-247-0300 and Domicile Realtors at 513-761-6800.